There's a whole lot of hype around temporary interest rate buydowns, which you'll often hear called a 2-1 buydown. But does the program live up to the hype? In this video, I'm going to explain how these programs work, when they're a good idea, when they're a bad idea, and when they're just honestly silly, which is a lot of the time. By the end, you'll be able to judge if a 2-1 buydown is right for you. But first, it's important to understand what a temporary interest rate buydown is and how it works. This is a loan strategy that lowers your initial monthly payment without any of the risks of an adjustable rate mortgage. You get a plain old fixed rate loan, but for the first 1 or 2 or 3 years, you pay a lower monthly payment. And the most common version of this by far is called a 2-1 buydown. For the first year of payments, you pay a mortgage payment that's based on a rate 2% below your actual fixed interest rate. And then during the second year, you pay based on a rate that's 1% below your actual fixed interest rate. So you only have to start paying your true full monthly payment based on your actual locked-in interest rate starting in the third year. And this may sound like a little bit of a magic trick, but it's actually really simple, and there's no rabbit and no hat and no magic. At closing, someone, and we'll talk about the options for the someones, deposits money into a subsidy fund, which is literally a savings account that's kind of attached to your mortgage. And the amount that goes into that account is exactly the difference between your real monthly payment at your real interest rate and the discounted payments that you're going to be paying during that buydown period. So every month, when you pay a reduced monthly payment, your lender has this subsidy account that they can dip into and plug the hole between your real payment at your full rate and the discounted check that you're writing. And they'll do that through the period of the buydown subsidy. And then once you run through all the money in the subsidy account, you start making your full monthly payment. And unlike an adjustable rate, again, you know exactly what your monthly payment's going to be every month of your loan. The buydown's fully scheduled out ahead of time, so there are no surprises. Now, a 2-1 buydown is by far the most common version of this program, but my company offers buydowns in a bunch of different flavors. We have a 1-0 buydown, a 1.5.5 buydown, a 1-1-1 buydown, a 2-1 buydown, of course, and a 3-2-1 buydown. The bigger the discount and the longer the subsidy period, the bigger the initial deposit into that subsidy fund at closing. And it's kind of obvious that this strategy has a lot going for it, especially at a time when rates are elevated, which is why they're getting so much attention right now. If you're looking for the lowest possible initial monthly payment, a 1 or 2 or even 3% discount on your initial interest rate can make a real dent in the check that you have to write each month. And the time frame for the savings coincides really nicely with your initial years of home ownership, when your budget's probably as tight as it's ever going to be. Having a cushion to make improvements to your new place or buy furniture or cover any surprise curveballs your new home throws your way can bring real peace of mind. And a buydown really can be a great fit if you, say, expect your household income to increase during the first few years you own your home. Maybe you're growing a new business or expecting a promotion with a pay raise, or you have a partner who's resuming work after time in school or time at home with a new baby. A payment that ramps up as your income ramps up can really make a lot of sense. Or if you're near the end of the line with a significant expense, like a car payment that's close to being paid off, or a student loan that's going to be paid off or forgiven, or your kid is graduating out of daycare or private school or college, a temporary buydown could really nicely dovetail your mortgage expenses with your improving cash flow. And if you're buying a home when interest rates are elevated, but feeling optimistic that rates are going to come back down in the future, a temporary buydown could take some of the sting out of higher rates while you bide your time waiting for the opportunity to hopefully refinance and lock in a lower rate and payment. But I can't emphasize enough how important it is to go into a temporary buydown with your eyes wide open. You may feel optimistic that rates are going to fall, but nobody knows what the future holds. Nobody has that crystal ball to say, hey, you can definitely refinance within the buydown period. And I hear too many people saying this in too much of the information that's promoting these programs out there. So hope for the best, but make sure you have a plan and that you can afford the full monthly payment. A buydown is really a disaster waiting to happen if you're just struggling to make ends meet at the initial monthly payment and you don't have higher income or lower expenses or something else on the horizon that's going to make room for the increases that you know are coming to your payment. Homeownership should be a source of security and a positive thing for your financial well-being. Being house poor and stressed out is no fun. Do not set yourself up for that kind of misery. To set up a temporary buy down, like I said before, we've got to get money into that subsidy account at closing. So let's talk about where that money can come from. A buy down can be funded by the buyer, the lender, or the seller. And I just have to say this, and maybe I'll take a little flack for it, but if a lender suggests that you fund your own buy down subsidy, don't walk from that lender, run. What they're basically recommending is that you hand over a bunch of your own money that you already have so that they can hand it back to you. And that's just silly. But what's worse is that the money you're handing over gets locked up with your lender in that subsidy account, and it can only be doled out little by little under the rigid schedule of your buy down subsidy over a period of years. So if you have an emergency and you need access to cash, that money is not available to you, and subsidy accounts don't earn any interest. So it makes a lot more sense to have someone else, not you, pay for the buy down. Now, sometimes lenders are willing to fund a buy down subsidy, which sounds pretty great. I mean, who doesn't want their lender to pay for a discounted interest rate? When you see a lender-funded buy down offered, it's almost always going to be a 1-0 buy down. I don't think I've ever seen anything but that. That's a 1% discount for the initial year of the loan. You start paying your full payment at the beginning of the second year of the loan. It's not as exciting as a 2-1 or a 3-2-1 buy down, but it still sounds pretty nice, right? But you know the expression, there's no such thing as a free lunch. Well, that definitely applies here. A lender offering you a 1% discount for the first year has to make that cost back by charging you 1% more someplace else. There's just not that much margin in mortgages. So before you sign up for a lender-funded buy down, I'm not saying don't, but you should compare how it looks and the benefits you get from a loan with a lower cost that doesn't have a built-in buy down. Now, by far, the most common funding source for a buy down is the seller. There are a lot of reasons a seller might be willing to chip in to fund a buy down subsidy for you. Maybe they're motivated to sell really quickly, getting divorced or something, or relocating out of the area. They could be struggling to find a buyer in a slow market, or maybe the house is a fixer-upper and they know their buyer is going to have to do some work to the property after closing. But whatever the reason, some sellers are willing to offer a credit, or what lenders call a concession. Funding a buy down subsidy is actually just one of 8 ways a seller can offer a concession to a buyer. So before you ask your seller to pay for a 2-1 buy down or any other buy down subsidy, I think it's really important to pan back to the big picture. To a seller, all concessions are the same. $1 of concession is just $1 less that that seller is going to walk away with and put into their pocket at closing. But to you as a buyer, all these different types of concessions can play out in really different ways. And the video linked above explains all 8 types of seller concessions with examples so you can see how different types of options look side by side and kind of hear me explain the logic of different types of concessions and why you would do one versus another. So be sure and check it out for more detail on this topic. But for this conversation, it's sufficient to say if a seller's willing to cover a buy down at closing, they'd also be willing to pay some other type of concession that carries the same cost, because again, it's all the same to them. So for example, they might be able to do a much simpler option, a straightforward credit to your closing costs. If the seller pays for a credit that covers some or all of the closing costs that you would have otherwise had to pay at closing, you'll have less money to bring in when you close. And if you have less money due at closing, and maybe you're seeing where I'm going with this here, you could bank the savings into your own DIY self-funded interest-bearing subsidy account. Interest-bearing, you can earn some interest on it. So instead of having money tied up with your lender, paid out at that set rigid schedule, you'll have control. You can set up a buy down subsidy schedule just like the one your lender would have done for you with a formal buy down. In fact, reach out to me and I'd be happy to give you a spreadsheet you can use to set up your own buy down subsidy and track it yourself. My contact information is in the caption below. And with control over the account, you'll have the flexibility to change up your schedule if you want or you need, or break into the funds if you have some other financial emergency that's more pressing, and you'll earn $1 or $2 of interest in the meantime. Even if all of this makes sense and you totally get it and you fully understand how the buy-down subsidy works and that you could ask the seller for a credit instead, you could use your own funds to do the same thing, sometimes a buy-down just feels good. So if you're still kind of like digging the idea of a buy-down, don't feel bad. As I'm recording this video, interest rates are as high as they've been in about 20 years, so if seeing a smaller payment on your mortgage statement for that first couple of years is gonna help you sleep a little better at night, go for it. Negotiate a buy-down, let your lender handle all the bookkeeping, and enjoy seeing that lower monthly payment on your statements. There is, however, a really important use case, which is where a temporary buy-down offers a huge benefit, and this is my favorite use of a temporary buy-down. Let's say you've already negotiated a credit from your seller that exceeds your estimated closing costs. Seller credits are limited by loan rules and by the actual amount of your costs. If you negotiate a credit that's more than your actual costs, your seller is going to get to keep the difference. And we don't want that. If your seller's willing to pay a credit, we want to find a way, really the best way, for you to benefit from every last penny that they've agreed to pay. So it's really important to work closely with your lender, understand your costs, understand all the options. And a temporary buy-down can be a great way to gin up some extra costs for your seller to pay on your behalf. Clients of mine who closed just last month are a really perfect example. When they wrote their initial offer, the seller agreed to pay $15,000 of their closing costs, and then they did their home inspections, and the inspections weren't perfect, and it gave them leverage to negotiate for another $9,000. So they've got $24,000 of seller credits. That's a lot. The $15,000 in that initial agreement was actually enough to cover all of their closing costs. So when they finagled that extra $9,000, we had to figure out how to spend it. Or again, it was gonna go to waste. The seller was gonna get to keep it. So one idea that we explored was to have the seller pay something called discount points. Discount points are basically prepaid interest. Sometimes we call them points, and this prepaid interest permanently lowers your interest rate and payment. And that sounds great, and it can be a good idea, but in their case, the impact on their monthly payment was pretty small, and the break-even point, which we worked out using a spreadsheet that I've built, showed us that it would take 5 years at the lower rate and payment to fully pay them back for that extra upfront cost. And discount points are non-refundable. So if rates dip anytime inside of 5 years and these clients are able to refinance, some of the points that they had the seller pay for them would just go to waste. And that didn't feel like a good bet. They're actually pretty optimistic. We talked about it, and they feel their chances to refinance inside of the next 5 years are pretty good. So this is where a temporary interest rate buy down offers a huge advantage. No matter what, you benefit from every penny of a temporary interest rate buy down. If you keep your loan through the full term of the subsidy, then you get a lower monthly payment. But if rates dip and you can refinance or you pay off your loan in some other way, maybe you win the Powerball before the subsidy fund runs out or something, your lender should credit any remaining funds in that buy down subsidy account that haven't been spent on subsidizing your monthly payment toward your loan balance. And you want to verify this with your lender. Not every lender has to, but most do. So if you get the chance to refinance before the subsidy fund is empty, before it runs out, the seller's money in that account will wind up offsetting some or maybe all of the cost of your refinance, which is actually a pretty nifty heads you win, tails you win kind of scenario. And that's exactly why these particular clients decided that a temporary interest rate buy down made the most sense for them. As luck would have it, a 1.5.5 buy down cost just about exactly $9,000. So adding a buy down created a place to spend that extra $9,000 that they negotiated after their home inspections, and now they'll enjoy a significantly lower monthly payment for the first couple years of homeownership. Thanks so much for your time watching. Before you take off, please take a moment to like and subscribe if this video is valuable. And to learn more about all the ways you can leverage seller concessions to your benefit, stick around and watch the next video on smart options for spending seller credits.